the risk of losing your money. Yes, you can also lose money if you invest your savings in an unplanned manner or without understanding the risks associated with investing in different kinds of products. There are four primary asset classes most individuals can invest their money in. Equity. This also refers to stocks, which are traded in the stock market. Debt. This refers to products like fixed deposits, bonds, public provident fund, PPF, national savings certificates, NSCs, etc. Real estate, residential and commercial property or land. Commodities, stuff like gold, silver, etc. In financial terms, risk of an asset is defined as volatility in the price of that asset. What this means is that if you buy a high risk product, the probability of its price going up or down in the short term is high. Similarly, if you buy a low risk product, its price will probably not fluctuate too much, either up or down in the short term. Let's understand this with practical examples. High risk, high volatility asset, equity. Akshay invested 1 lakh rupees in shares of a technology company. Over the next 6 months, the stock price experienced these changes. Despite the wild swings, Akshay's investment ultimately grew by 8% over 6 months, but the journey was a roller coaster. Low risk, low volatility asset, fixed deposit. Maya invested 1 lakh rupees in a fixed deposit offering 7% annual interest. Her investment growth was steady and predictable. Maya's investment grew by only 3.5% over 6 months, but there was zero volatility or risk of losing the principal. Equity. This is a high risk, high growth asset class. Your money can grow significantly, but it can also lose value significantly. These products have given average annual returns of around 12% to 15% per annum over the last 20 years. For example, if you had invested 1 lakh rupees in a good quality equity mutual fund in 2000, it would be worth approximately 18 to 20 lakhs rupees today. However, during this period, there were years like 2008 when the value might have dropped by 50% temporarily. Debt. These are low risk and low return products. Your FDs or PPF give you an annual return, which is pretty much assured. Over the last couple of years, they have given a return of 7 to 9% per annum. For example, 1 lakh rupees invested in PPF in 2000 would be worth approximately 4 to 5 lakh rupees today. There would have been no drops in value along the way. Real estate. These are again high risk products which give high returns over a long term. They are also very liquid because it's difficult to sell real estate quickly if you need money urgently. Consider Sanjay, who bought an apartment in suburban Mumbai in 2005 for 30 lakh rupees. Today it's worth 1.2 crore rupees, a 300% increase. However, when he needed money urgently in 2009, he couldn't sell it quickly even at a 20% discount because there were no buyers during the global financial crisis. Gold. Rise or fall in prices of gold is based on demand and supply in the international market, and its prices can see volatility at times. To understand the risk of losing money better, you need to understand the difference between a paper loss versus a real loss. Let's say you have 1 lakh rupees today, which you want to grow aggressively and decide to invest in stocks, also known as shares, via the stock market. You identify a good company X whose share price is currently 100 rupees and buy 1000 shares of the company for 1 lakh rupees. In 2 months' time, the price of the share goes up to 120 rupees. You are very happy as your investment has grown to you have made a profit of 20,000 rupees. However, this profit is on paper only, and until you sell your shares, you will not have a real profit. Let's say you decide to hold on to the shares, assuming the price will go up more. However, 1 month later, the price of the share falls to 110 rupees. Your investments now worth 1.1 lakhs, and compared to 1 month earlier, you now have a paper loss of 10,000 rupees. After another month, the stock price falls to 90 rupees. Your new paper loss is 20,000 rupees compared to the previous month. However, if you look at the total scenario, 4 months ago, you bought 1,000 shares at 1 lakh rupees. They are now worth 90,000 rupees. So your net loss is only 10,000 rupees. However, this is still on paper as the number of shares you own are still 1,000. Your loss will become real if you decide to sell those shares now at 90 rupees. If you continue to hold them for the longer term, the price might increase to 150 rupees or 200 and you will again make a profit. This difference in the stock price on a daily or monthly basis is what is usually known as volatility. And most individual investors are unable to handle this volatility and sometimes end up making irrational decisions. If a share's price is rising, they will continue to hold it on the assumption that it will rise further. However, once the price starts to fall, they sell to reduce their losses as they feel that if the price falls further below their purchase price, they will lose more money. Real estate is also a growth asset class and has given great returns in selected pockets of the country. It's a myth that property prices only go up and up every year. They are also subject to price fluctuations and, more importantly, liquidity. To ensure that you don't lose money, it's recommended that you invest it in a mix of asset classes, also known as portfolio diversification, based on the duration you want to stay invested.